Hi, Alpha Team Planter here with this week's preview, week commencing 8th of April 2024. Remember, today we're going live around any time between 1 and 2 UK time. I'll post that up on the market chatter. Depending on which video you're watching here, you may be watching a recording of that. There'll be similar content, but obviously the live show, we can have interactive questions. But back on with the show. So I've been power washing the markets. It's Easter time. When you come back, I get all my spring chores thrown at me, and one of which is doing the terrace with the power washer. Great fun. And you get rid of all that grime and see what's underneath. And it feels very much like we need to have a little go at the markets at the moment. Lots of confusion around, a lot of flip flopping. And that's how I described how I thought the first week of Q2 would go. And we weren't disappointed with the pieces of info that came through. ISM manufacturing on Easter Monday, that actually went back into expansion unexpectedly. Small signs of manufacturing employment coming through as well, which was a precursor to what came in the NFP later in the week. ADP midweek, the private payrolls, that was red hot and suggested again that at least private payrolls would move in the positive direction. That proved to be the case. We'll have a look at non-farms in a minute. ISM Services, now I've been talking about this a lot, and that actually started off the flip-flop to the downside in the dollar because we had a dovish reading come through. 13 of 15 sectors that are reviewed there saw no change effectively in prices paid, but two of them saw big drops, and that actually made the prices paid element drop the most on a 2 monthly basis since the 80s, I think it is. We'll have a double check of what I found out on that later on. But it was mainly real estate and the rental sector. Now, obviously, that has a connotation for this week's potentially expected to be another hot US CPI print on Wednesday. That is going to be the driver. We've got the market and the talking heads all pushing us back. We'll show a chart. 2-year and 10-year US yields have both pushed up to rally highs, or highs since we started rallying in October, November 23. We've even got Bowman suggesting we might have a rate hike. I think that's a little bit out there, but she's the only one that's actually been brave enough to say it's a possibility. And we saw lots of volatility in the markets around speeches. And the other important point of the week, the breakout of the XLE energy sort of ETF, and oil itself, Brent into the 90s, WTI up to 86. So we've got commodity inflation outside that now. Previously, remember, I talked about looking to fade oil because the demand wasn't there. The facts are changing, and we need to change our view. And on that basis, I think we're now seeing some upticks in Chinese manufacturing data. The manufacturing indices across Europe, in the main, were all a little bit better than expected. So, we be careful of fighting that. The Americans themselves were going to top up their US reserve fund that they'd had to tap into during the start of the Russian crisis, but they've decided that the market's too hot and they're putting undue pressure on that, so they're going to hold off and wait for a pullback. So then we got to non-farm payrolls, and again, that had an upside beat, another hot figure at 300 on the month. Revisions were small up by about 20,000, but remember I told you there are two reports. You need to look at both. The household doesn't get as much media attention generally as the establishment one, which is all the headlines on NFP. But underneath the hood, the labour force went up by about 470,000 people. And a lot of people weren't really sure why that was happening and where are these people coming from. But the big mover, despite the fact that overall part-time employment for economic reasons didn't really shift, part-time for non-economic reasons, which is people being moved to short-term hours, I think, was up by a massive 590 odd thousand on the month. We talked last week about the shift to part-time versus full-time is normally a precursor to a big economic slowdown. and also takes away the upside pressure on wages. We're seeing that evidence. The quits rate is low. That means there aren't high-paid jobs to quit for, to run away and pick up. So it's getting a little bit easier for companies to find their employees. There are some pockets, as we've seen in a couple of ISM services, where they're struggling to find players, but that's not because of necessarily the uber tightness. It's just that those industries are out of vogue by the look of it. So that wasn't as hot as you'd expect, but there is an effect on the CME tool, and June is now only marginally in favour of a cut. Looks much like July will be the place to go. We'll have a look at that perhaps later. So, the backdrop is slight pushback out in rates. So even though we've had that kind of flip-floppy move, we thought the start of April could see a bit of dollar strength. We did start the week like that. Then we've slipped into what we showed up to be seasonality for April to be dollar week. That was playing out, but we've had slight pushback since. But it very much looks like it's nesting. You can see. We'll have a look at the dollar chart in a short time. You can see how that is still not taking out new move highs at the moment. Still looks like it's nesting. There's still scope for it to go slightly higher before we've got something else in play. And to me, the danger here is that we do go into Wednesday, that rent element, which is 33% of US CPI, starts to come in weak properly. The ISM Services is suggesting it. And if we get that massive downside surprise, then that'll be a real kicker for breakout. One of which is, look, I saw this chart pop up, and it's giving you a summary of where the major investment banks are, and they're all still looking at June as their first cut. Most of them still in line with the Fed. I mean, at the moment, there's less than 3 rate cuts priced in for the Fed, yet the Fed are adamant that 3 is still favourite. So it's not often that you get the Fed ahead of the markets. Remember, it was 100 basis points extra, 150, 175 amount of cuts at the start of the year when everyone was saying that's preposterous. Now we've more than reversed back. Somebody's going to look quite silly soon. The way I look at it is we're talking about rate cuts by the end of the year. I think we need one for, if possible, Powell would love to get it in there. They'd like to get it in there before September, which is often seen as the most sensitive month politically. And I highlighted it before, the November meeting happens 2 days after the election result. So November and December can slip in there quite easily to get you 3, and everybody wins. So, all this fretting about June, not necessary as long as the messaging is that they're still on track. One factor I talked about a lot was funding, where it's going. The dollar is seasonally weak a lot of the time because money flows out to other regions once people get confident, and the disparity between PE ratings in the European stock 600 and US equities has seen hedge funds put on US shorts and start to employ money into the regions. With Europe, I think it's almost on its record discounts at 0.65 PE relative to the States PE. So you're getting to see, a little bit of switching flow going on there. Starting to see upticks in German PMIs and data. China picking up. Germany's a massive exporter to China. So it all starts to come together. The DAX likely to power on with the secondary effect that if tech does slow down, the less heavy European indices may be a beneficiary of any exiting sell flows. Obviously, there was a good sort of geopolitical discussion on my chat last night, all about the opening of gold, etc., and what's driving that. Obviously, wars and geopolitics are in there to the fore, but there's a lot of people are picking up on the fact that this whole physical asset positioning by central banks is the main driver within all the positives that are out there. Is the demand as strong as it was last year? Well, the demand, I think, is still as strong. Whether the availability and supply is there is another matter, and that's probably why things are squeezing. David Rosenberg has come out today. He's a famous economist, was brilliant in the GFC. He has his own, I think he was a former Merrill's economist, but he's got his own shop now. He's a Canadian. And he's come and joined the 3,000 Brigade, which we've talked about. I've been talking about that as being the inflation-adjusted fair value level from the 80s high. And he's another one that is there on the back of that. There's clear evidence that people are far too reserved in the US dollar with that the impending negativity around that. I mean, if there is a financial crash, you'll see some flight to safety over the next year, but in general, the trend is down, and people don't want to be holding assets that are falling. And as can be seen around the world, if you're the wrong side of the geopolitics, you don't want to be frozen out of those assets, a la Russia, which is one of the big drivers for China. But in general, having seen physical assets out of favour by central banks, they're now realising with currency debasement that you've got to be buying them. And the other major factor of why Asia sessions tend to drive a lot of the moves, like it did again overnight, is that Chinese domestic demand is massive. People are not overly confident with what's happened in China with their economy and stock market performance. So the domestics I've talked about before, they've been buying gold magic beans, plant them, see the stalks of superior outperformance grow. Japan's been quiet, not a lot happening there. Apparently, the last 13 days range has been so tight. It's not been like that since the 1980s. So that very much is starting to look like a barrier. And when you see a barrier with a flat line and diminishing spikes to breaking it, it's very much, when you see these flags, the barrier normally breaks through the straight line. So unless Japan does some serious intervention, it's we're probably going to have to see that break before it comes off. I will show a chart about the 2 years and 10 years in the US because they have both hit relative highs with all the continued chatter on rate pushback. Yeah, so what have we got coming out this week? Well, it's pretty dull. Monday's dull. Very little happening. In fact, just looking at the overnight data, like the German economy, German imports, German industrial production, big beats. So it looks like there's a little bit more activity going on. Exports still struggling, so they need that Chinese market to pick up. Trade balance slightly off. But it's this number here, industrial production, and this is what's driving commodities and such like. That's a decent performance there. Good to see. So yeah, Japanese PPI, we'd like to see this embedded inflation coming through the system over there. That'll be Wednesday morning, Tuesday night. We've got the Royal Bank of New Zealand rate decision. That's unlikely to change from 5.5%. And then we've got core CPI. I missed out Tuesday because that's another boring admin day by the look of it. So, follow the ranges, listen to the commentaries for Monday and Tuesday. Probably going to be a very technical couple of days of trading. Canadian BOC on Wednesday too. That should be unchanged at 5%. And the FOMC meeting minutes will come out in the evening. It'll be a shock if there's anything new there from what we heard from Powell. But there'll be a few details to latch onto. Overseas and domestic investment flows from Japan on Thursday. Bank of England credit conditions as well. Given what happened this week with lending in the UK looking a lot stronger than we anticipated for February, and mortgage approvals likewise, it was disappointing to see the pullback in the housing price index, but that's more probably sellers coming down rather than there being weakness in underlying demand. But either way, it shows that the UK market does need a helping hand from the rate side, just as the Tories do. We put out a little meme on that. Thursday also likely too early for anything to happen. We have had weak CPI from the Eurozone, but they've been at pains to tell us June, and the wages is what's driving that. So unlikely that anything moves. And then obviously US PPI and jobless claims on Thursday. We need to see if the mood music changes from the CPI first. Last month, the PCE read-through elements had flatlined. They were still upticking. The investment performance and the hospital costs were baselined into the price, but we'd like to see those start to tick back if possible, please. Friday, Chinese trade data. Again, there's every chance that shows an uplift. And we've mentioned it before, we're looking for import improvements there just to show that the domestic economy is picking up. Again, not sure if we get that. Everything seems to be hitting the tick boxes on industrial production and the commodity side. Not quite sure if retail is back. We've got UK GDP and trade data for February, which is obviously the second month of Q1. A little bit of industrial and manufacturing production. So we'll see whether the UK is going along with what is looking like a global trend at the moment. And then we get the confirmations for the Euro CPI figures for March from France, Spain, and Germany. And finally, in the States, we'll get the Michigan 1 to 5 year inflation expectations and the sentiment surveys, which are normally well followed. So it's US inflation figures that are at the forefront this week. There's not a lot of penciled in talking heads at the moment, mainly because we've got central banks updating. The Fed guys, I mean, there were 20 talking heads from the States over the week. Hopefully they're having a little calm down moment, but I'm sure some of them can't resist it, can they? It's like I think they're social media stars. Very few major stocks reporting, but as I said, if the markets do get stuck on Tuesday, WD-40 is reporting, so a little squirt of that should sort things out going into CPI. Publicis is, I think, normally the first of the big advertisers to tell us what's going on. Bit of a leading indicator there. That's forward bookings of advertising spend. So you normally get a good trend for how confident companies are about consumer spending, etc. And then Friday, we kick off the bank's earnings season again. Stateside, that gives us JP Morgan, Wells Fargo, Citigroup, and State Street. And then BlackRock, who already in their own chairman's letter have been quite positive last week, will give us the state of play for the investment side of things. Weird things that I noticed in equities that have been going on. Good charts out there. Someone showing how would you have put any money on DELL outperforming Apple over the last 5 years? Well, that has happened. And good old Tesla, that's turning into a bit of a disaster. It's obviously out of the Magnificent Seven. Yul Brynner not happy with it being down 33% year to date and 61% from its all-time high. But, I'm sure Elon will be out giving us some kind of pump talk from Bitcoin that suggests it should be higher. Lots of last week's highlights to go through on the PDF when you get it. I've chatted through most of them. Let's just have a look, scan, see if there's anything I've not mentioned. Yeah, Powell was the main speaker of note, wasn't he? He didn't really change anything. Said all the usual stuff. It's Kashkari saying that there might not be any need for any at all. Goolsby, a non-voting Dove. When I watched his chat, I didn't really think he was saying anything that he'd not said before. But people seized on the fact that he was being reasonable to wanting the data to be justifying any rate moves. And then obviously Bowman did her Catherine Mann moment and said that we might need a rate rise. I think that's a little bit over the top at the moment, but you never know if the trend goes that way. Talked about the Halifax and Nationwide non-farm payrolls. I think we covered most of that. Yeah, Goolsby actually mentioned he's beginning to see consumer delinquencies go up. So that's normally a precursor to things slowing down. So nobody, that didn't fit the media negativity, did it? So that was left out. So just reiterating back on the ISM Services prices paid on a 2-monthly basis. This was on zero hedge. That was the biggest 2-month plunge since 2008. Yeah, just be careful. I said before, the problem with saying that everything is chugging along and breaking out to the upside. I've listened to podcasts before of former Fed members, and they're saying what always catches them out is the rate of change when it goes. Remember, people look at a lot of these metrics in real terms. The inflation is still high. You don't need the nominal, the pre-inflation number to drop too much before they're behind the curve and having to do 50 bips plus, just like they did on the way up when they were behind the curve. So, don't be surprised that it won't be, when these things miss, it won't just be the odd 0.1% miss. It'll be percentages, and it'll be unexpected. So, the data amongst some of these daddy boy pieces, the ISM services, that is the biggest part of the economy, and the employment figures, where the headline looks scary, but the detail underneath is creating the wrong mix. Just look out. All of a sudden, these things could suddenly, whoa, where did that 100,000 print come from? And boom. Yeah, so, we said post the non-farm payrolls on Friday, headlines would create a little stir in gold to start with, but it would calm down and carry on with the trend. Didn't it move something like $63 to the upside from post non-farm payrolls? Incredible resilience, stronger dollar, supposedly rates pushback, shows you that the main trends are the central banks, are the geopolitics. Yes, at any point we could start to see the geopolitics calm down, but if that happens, surely you get less of a flight to safety into the dollar, and you get the added dollar kicker on the unwind. So net, it looks like an unstoppable delta force. We're going to look at the charts in a minute, and I've switched back to it looking still to be nesting. I've recounted the waves, and it's so impulsive that it's unlikely that all those threes have filled in yet, and we're very much within high degree threes at the very first juncture. I'll demonstrate that. So this could really, really push on. We talked about 3,000 is now becoming a very credible place to go. Indices, again, I still think that we are in for one more high on these 3, 4, 5s before we get a decent, at least wave 4 pullback. Lots of tub thumping that the momentum is dying in the Dow, etc., etc. But there is still has the appearance of doing a 3-wave correction. It may do a double of what it's already done, but I feel like there's one more breakout to come, and that could easily come on the back of midweek. But I think you just got to be careful getting whipped out here. Germany, like I said, is seeing flows come in from the hedge funds, the quicker short-term placing money. There's a big chance you get whipsawed here if you start putting on aggressive shorts. So a quick look at the dollar, not the dollar, the gold overnight. I said we were discussing here, and on my chat, who were we talking to? PGE07. He had a lot to say about the geopolitics, and he was set up for a gold sell-off. He had good discipline. He had a level that was slightly up for the open, and it didn't open up at all, so he missed it, and we got the pull down to 2306. My idea was that we were going to open and pull back down into this 2300 type level. Big solid support down there. We bounced off it twice. The confirmation second bounce went zooming, Rosenberg type comments, but it looks very much like that Asian demand we've talked kicked in yet again. So we're doing 1-2s, 1-2s, 1-2s again, 1-2s. That's the nesting effect we talked about weeks ago. And in fact, we have got a longer term chart just to demonstrate that a bit more. That's in the pack. But here we keep doing the breakout, consolidations, breakout. This just keeps carrying on with very impulsive upside. So it's and the fact that you're here, you're in a 3, it's more than likely to have as your first instinct that the 3 should be longer than the 1. It can be shorter as long as it's not the shortest wave in total, but it doesn't feel like we're doing that folding in anymore. 3, 4, 5s could start to have seen as track sideways. I still think it looks like we're heading for probably 2,500 before we get the first meaningful pullback by the look of it. Yeah, so within the pack, just on a slightly longer time frame, ignore all the nomenclature. That was all for a previous. I just moved them to the side. So you've got the intermediate 1-2 wave playing out here. Within that, we've got the minuet and sub-minuet playing out to get as a minor wave. So it's intermediate, and the blue ones, the red ones are doing a 1-2. We're breaking out again in a sort of 1-2, 1-2 fashion, setting us up for a third of that red 3, of the blue 3, of, if we drop down here, would be the black primary 3, all in the first wave of an upcycle, in the 5th wave of a grand super cycle. It's just huge time moments in history, moments of wave theory breaking out. It's all very impulsive. It's an absolute classic. It will be talked about for years to come. But the next breakout, 1.618 level for this minor wave 3 is up here at 2563. So we're going to have a preliminary surge for this lower degree minute wave 3 before that pulls back and eventually goes up to there. Pretty convinced. You can see that the weak dollar is having the strong dollar is having absolutely no impact on the general trend. People are just adamant now. This is going banzai. This is your new crypto. It's adjusting. The fact that you've got potential supply constraints in there is giving people confidence that it's a physical asset that won't get devalued, and it's looking to catch up on its long-term miss on the inflation hedge now that it's back in vogue. So a lot of people could say that the reason it did underperform is because it was jettisoned by the central banks. That is now in reverse. So we can't really fight that trend. Just briefly, this is the XLE, the energy sector SPDR US ETF effectively. And look, last week's weekly move was a breakout to the current structure. That could easily do a double of the moves from the March 20 low. You never know. Look at the way that's set up, even if it's a consolidation counter trend move. So watch out. Once you break these long established barriers, you normally get a big breakout. So I've had that chart up earlier. Obviously, the dollar has been making the move down. That's what I talked about earlier. The start, the ISM manufacturing gave us that short-term high. Very much looks like we put in an equal legs counter trend 2 wave. We're now back down into what should be the 3rd wave and the early stages of it. An impulsive move down through ISM, a 3 wave back. The fact that hasn't taken out this high yet, 104.4. So overnight, right in the preview, I'd suggested that we're going to get equal legs, 104.4 level. It has failed around there, come back. We're now doing this nesting of impulses, 3 waves. At some point, it feels like this very much is going to break down. That almost looks, the arrow that I put in almost could be a downward sloping trend line for that move at the moment. Keep an eye on that. Probably each time it's going to break down. That does seem to be the dollar situation. But when you get these connectors, because it's not putting a brand new low, that could be 3 waves up connector, another 3 wave move here to double it before we eventually come away. That could be. We could well see that this week. We could see a little bit of nervousness going into that CPI figure, and then that. It's all looking very set up, isn't it, for the dollar to give way midweek? Yeah, similarly, the Dow, it's been out of the channel, had the overthrow, the classic overthrow, and the fact it's come back in, the bears are all jumping up and down. We've kind of been preparing for this for weeks, haven't we? Saying that we thought we'd got one more final surge to come. So if we get a breakout again above that trend line, I think it's happy days, and we've got 4 or 5% left in this. Then I'd start looking for decent pullbacks. So it's a moot point whether, as a trader, do you want to be messing around with a potential final fifth? We've put in an equal legs by the look of it, sell off already and started to bounce from Friday's non-farm payroll. Very much need to keep an eye on which of these breaks first. Is it a break out the channel, or do we break through that support and do a double correction down to here? The danger is if we start coming down here, you get to the one spot 618 level, then that can be interpreted as being a little bit more impulsive. The bears will get very excited, and we might have to consider a different kind of structure. We may be doing a deeper pullback for wave 4, but I think the fundamentals will have to change. If CPI comes in badly, then all bets off, and we're going to start doing some proper consolidations. Not sure it's going to be end of the world stuff. You'll be told it is. But until something changes, I still think the setup just needs this one more proper breakout. But if I'm just describing that myself, it sits on hands time. We're a little bit in between there. I'd like to see a retest of that 1 for 1 or get close, and then buy for the breakout with a stop loss. And equally, if we get up around the channel level and break that, I think you'd buy that again on the retest back. Off you go. The VIX had its biggest 1 week move since we were back here in October, just pre the yield contraction, and the risk got very much a risk on mode. And you can see how the implied volatility, the risk on, saw this implied volatility just absolutely evaporate. Have we put in the counter trend here, which is about to fail? This could be the spike. Yields are starting to get to a put up or shut up moment. That is the other chart I have on this tab, which basically is those 2 and 10-year in yellow and the 2-year yield candlesticks in the States. You can see where that rally came in from up here, the end of October, in line with the VIX coming off. We've now bounced up to counter trend move highs on the 10-year 4.4, and the short-term end, that's had its highest close, daily close for the move. Obviously, a couple of wicks that came up here. Be very interesting if this holds, but it just very much looked like there's this policy move towards issuing at the short end by the Fed. They've got to try and pay for the next few years, the fiscal deficits. There's a lot of chatter that the acceptance is coming, that they're just going to have to do that at the front end. That means more supply, means high yields. Also means people start to get very panicky about the kind of inflationary read from doing that. And hence you're seeing moves out in commodities and particularly gold. And we talked about Germany for weeks now being the powerhouse of this recovery. We've put in an equal legs 4th minor wave here, bounced off it straight away. The AI machines, they all know what they're doing at the moment. German data improving. We've seen more industrial data overnight. Can only help this trend. I feel like, again, we've got one more high at least short term coming here. It'll take quite a lot to unwind this. Obviously, we've had a 3 wave there. We may be putting in a consolidator and get further pullback, but we're still massively within the channel. You may get a false break at the low end of this channel, perhaps, before we go. But at the moment, it pretty much looks like that equal legs is doing the business. New all-time high on the way. The seasonality and the inflows, the data, it's all backing it up. We could just do with the cherry on top being the US CPI suddenly becoming, not becoming or stop being the ginger stepchild in the corner. Anyway, more chatter later on the live chat. Hopefully you can join us for that. Love to see lots of comments from you. Please engage with me on my chat. Come in with any questions you've got on this, or questions on the YouTube comments. We will get back to you. Anyway, good luck with your trading out there. Plenty out.